McAllister here, joined by Lyle, Fitterer, co-heads of the Muni Group at Baird Advisors. We thought we'd record just a couple of thoughts as we approach year-end. What's been a very difficult bond market this year, Lyle, as we know all too well. In fact, we've seen the biggest price declines in bonds this year than in the last 40 years, and we know why. Treasury yields have risen between 400 basis points on the short end, over 200 on the long end. Muni yields are up 250 to 200 basis points, and obviously elevated inflation is the cause and a very aggressive Fed response. We're probably going to close the year with a Fed funds rate, in the 4.5 range after starting at 0.
But it does appear we're at a turning point. I mean, if you look at inflation, well, it's probably not going to come down to 2 to 3% anytime soon. It does look like it should continue to decline over the next 3 to 6 months. We're starting to see signs of an economic slowdown. If you look at the housing market, where mortgage rates are up over 6% now, housing market is slowing. We're seeing used car prices come down. Some of the supply chain issues have actually eased. And probably one of the most important indicators that we watch is the shape of the yield curve. And as you said earlier, with short-term rates up more than long-term rates, the yield curve is now inverted, which historically has been a sign that a recession is probably around the corner.
So Lyle, you mentioned the yield curve and the curve inversions, and we recently did a white paper that looked back to the mid-1980s at 3 prior curve inversions. And here we looked at the 2s, 10s segment of the curve. Each of those preceded a recession. They lasted on average about 12 months. And what we found is that once the curve inverted, that had you purchased either short or long-term rates, both came down. The short end yields came down almost twice as much as the long-term yields did.
And in an environment like that, the temptation for investors is to really focus on buying that higher yield, even though they're only locking it in for a shorter period of time. But what we found is that free lunch, our so-called free lunch, is fleeting. It doesn't stick around for a long period of time. So if you look back historically, the better option for people with long-term money is to invest some of that money further out the curve and lock in those higher yields for a longer period of time.
So Lyle, for those investors that are willing to move a portion of their fixed income assets out the curve a bit, as we would consider right now, I think it's a great time to do so. We've got a great lineup. On the taxable side, we've got 5 funds that now yield 5% or higher. On the municipal side, we've got 5 funds that are yielding around 4% tax-free. So for tax-paying investors, that's equivalent to between 5.5% and 6.5%, or even higher than 7% for certain specialty states. So it's really a great opportunity right now.
Yeah, our 2 new recently launched municipal bond funds just reached their 3-year anniversary. The Baird Municipal Bond Fund and the Baird Strategic Muni Bond Fund, which rounded out our lineup now of 5 municipal bond funds to complement the 5 taxable bond funds that you talked about. The Baird Municipal Bond Fund has a duration of over 7 years. The Baird Strategic Bond Fund is a little unique to the Baird lineup in that it allows us some flexibility to migrate between short or intermediate duration, and it's for investors who are looking to hand over that decision to us. Over the last 10 years, interest rates have been low or negative from a global perspective, and many traditional fixed income investors have looked outside the asset class to generate income in their portfolios. With rates having risen a substantial amount, we think now may be a great time for investors to reconsider a core fixed income allocation.
We think bonds are once again acting like bonds. They're providing income for investors, and they also are offsetting the volatility in other parts of their investment portfolio. So thank you for your time and for listening to us today. And if you have any questions, please give us a call.